Here is a question that sounds strange until you sit with it. Whether your house burns down this year is a coin flip. Not a fair coin, but a random outcome. You cannot know it in advance. No one can tell you if your car will be in an accident next year. But an insurance company with 10 million customers can tell you, almost to the decimal, how many of them will crash. The individual outcome is random. The group average is not. That switch from one person to a crowd is the entire secret of insurance. Insurance is the business of making individual randomness disappear by averaging it across a crowd. The professional word for the crowd is a pool, and pooling is the whole idea. Many people pay small, predictable amounts. The few who suffer a big loss get paid from the shared pot. No one can predict which house will burn. But a pool of 100,000 houses can predict how many will burn because the fire rate is stable. The fires hit different houses each year, but the count barely moves. The math that makes this work starts with a number called expected value. Expected value is the long-run average of a gamble. You compute it by multiplying the probability of each outcome by its value, then adding them up. Take a house worth $100,000 with a 1% chance of burning this year. The expected loss is 1% of 100,000, which is $1,000 a year. That number is the starting point of the whole pricing story. An insurer prices a policy at least at the expected loss. If the premium were below the expected loss, the company would lose money on average every single year. No luck involved. So the premium is the expected loss plus the cost of running the business plus a small margin. In the house example, the insurer expects to pay $1,000 a year in claims, covers $150 of expenses, and adds $50 of profit. The premium is $1,200 a year. The customer trades a possible $100,000 catastrophe for a fixed $1,200. That trade is the product. Here is where the law of large numbers comes in, and it is the quiet engine under the entire industry. The law says that as a pool of independent risks grows, the average of what actually happens gets closer to the true expected average. The bigger the pool, the smaller the surprise. Compare one person to a million. One person's loss is a coin flip. A million people's losses are a schedule. The numbers make it visceral. For a 1% chance of a $100,000 loss, a single policyholder faces a standard deviation around $10,000. That is essentially random. Pool 1,000 of them, and the fluctuation per person drops to about $300. Pool a million, and it is under $10. With a million policyholders, the actual average loss per person sits within about $10 of the predicted 1,000. The law of large numbers turned a coin flip into a near certainty. This is why insurers want millions of customers, not a few dozen. Size is safety. But the pool only works if the risks are independent. Independent risks, like separate house fires or separate car accidents, pool beautifully because each house burning does not make the neighbor's house more likely to burn. Correlated risks where everyone fails at once pool terribly. A flood that hits every house in a valley, a hurricane sweeping a coastline, a pandemic. When one claim hits, all the claims hit. The pool offers no smoothing because everyone loses together. This is why fire insurance works. Why flood insurance is often a separate government-backed program, and why insuring a whole floodplain is a nightmare. Now the company's side. The premium you pay is a little machine. Part of it covers the expected claims. Part covers the salaries and the offices and the underwriting. Part is set aside as reserves, money held to pay claims that have not happened yet and to cover the bad tail. Regulators require it because a company that writes a policy this year must still pay a claim years later. And then there is reinsurance, insurance for insurance companies. A regular insurer buys its own policy to cover a catastrophic cluster of claims, so one hurricane cannot wipe it out. The biggest reinsurer in the world wrote $43 billion of that coverage in a single year. There are two ways the beautiful math can break, and the whole industry is built around stopping them. The first is adverse selection. If the insurer cannot tell high-risk people from low-risk people and charges everyone one average premium, the low-risk people say that is too expensive for me and leave. The pool fills with high-risk people, the average loss rises, the premium rises, and more low-risk people leave. The market spirals until it collapses. This is why underwriters ask questions and why premiums vary by risk. The questions are not a form. They are the insurer trying to keep the pool honest. The second failure is moral hazard. Once someone is protected against a loss, the edge comes off their caution. They take more risk, or they file claims they would otherwise absorb. The fix is cost sharing. A deductible means you pay the first $500 of any claim, so you think twice before filing a $400 scratch. A co-pay does the same in health care. The insurer does not want you protected from every dollar. It wants you to still feel some of the loss, because that feeling is what keeps claims honest. The same math shows up in every type of insurance. Health insurance runs on a pool of nearly the whole country, balancing moral hazard against the predictable need for care. Auto insurance is pooled and priced by risk class, so the law of large numbers pinpoints the expected accident cost per driver almost exactly. Life insurance is the pinnacle. Mortality is one of the most predictable numbers in all of finance. A healthy 30-year-old has about a 0.1% chance of dying this year. A $1 million term policy has an expected one-year payout of $1,500, spread across hundreds of thousands of similar policyholders, so the total payout per year is astonishingly predictable. Insurance is older than most banks. It was born on the docks of London, in a coffee house run by Edward Lloyd in 1688. Merchants shipping cargo across the ocean faced a loss that could ruin a family, so they pooled their risk. Many shippers each paid a small share toward a fund that would compensate anyone whose ship was lost. That merchant's handshake is the direct ancestor of the policy in your wallet today. Over 3 centuries, the actuaries turned the handshake into applied mathematics, building life tables and probability forecasts. There are about 30,000 of them in the United States, and they are some of the best paid people in the country. So the honest answer to why insurance works is that it is a numbers game, and that sounds cold until you see what the numbers buy. Buying insurance is, in expected value terms, a losing bet for you. You pay $1,200 a year for a risk whose expected cost is $1,000. You lose on average, but you are not buying a gamble. You are buying certainty. You trade a small, certain, predictable cost for protection against a huge, unpredictable one. The insurer makes its margin on the spread and on the diversification of the pool. Both sides are rational. That is why the system holds together and why it has held together for more than 300 years.